So chapter 15 is about finance and accounting. Could you all close your laptops, please? Everybody close your laptops, all, and no phones, please. So this is really important chapter. So it's about finance and accounting, and we will talk about financial statements. And one of your homeworks will be writing what the financial statements are that we're going to cover. There's financial management and finance and accounting. So financial management has different components. It deals with different areas of the company and how money is allocated, how money comes in and things like that. So a big part of financial management is planning and budgeting, right? So planning would be, planning is done throughout all the departments. Departments have plans for, the next year plan, right? Maybe they want to grow a team, maybe they want to increase production, maybe they want to have a higher marketing budget, they ask for money, right? And financial managers or in the financial management department, they deal with the budgets and they decide who they are going to allocate how much money to, right? And other resources as well, right? They monitor cash flow. We will talk about something called a cash flow statement. Cash flow basically is what's the money coming in and what's the money going out. Was this really the first slide? Yes, it was. Sorry, I had to double check. Investing funds. When the company has good cash flow, cash coming in that doesn't need to go out. In other words, they're keeping cash within the company. It's not really a good idea to keep that cash unless they need to use it right away, because that cash is just going to sit there and do nothing. Instead, companies will invest cash in other activities or in other areas that brings some kind of interest or some kind of additional earnings, right? Raising capital. If a company wants to grow, or let's say a company that's starting at the beginning, a startup needs to raise money to get going, to get off the ground, right? How do they raise money? We'll talk a little bit about that today. Where do they get money from? Or maybe a company is already in operations, but they want to grow. They want to maybe open another location or add another product to their product mix or whatever, right? And that requires cash, right? And then the evaluating and reporting, right? And this is where a lot of the statements, financial statements come in. Questions? All right. So addressing cash flow and budget. So there are cash inflows and cash outflows. This is what the cash flow statement will show you, right? You have customers that buy stuff, right? And because you have, here are just some examples. But that goes into, so cash goes into the company because they buy for products or services, right? So that's cash inflow. But then the company has some obligations, financial obligations to others, such as suppliers, right? They need to buy supplies. Let's say you're selling sandwiches, right? You have a sandwich shop. Who are your suppliers? Who do you, or what kind of supplies do you buy to make that product that the customer will give you money for? What are some of the things you have to buy when you have a sandwich shop? Bread, yes, what else? Meat, condiments, lettuce, and all those knickknacks that you put on a sandwich, right? Yeah. So that's your supplier. So you might buy, a bakery could be your supplier who supplies you the bread, right? And some, all the other things, yeah. Interest and dividends. What's interest? What kind of interest are we talking about? When might a company have to pay interest to somebody? What do we pay interest on? On loans, right? If a company has loans, on the loans you have to pay interest. And what about dividends? What are dividends? We will cover that actually in the next chapter. But does anybody know what dividends are? Ty.
When a company pays you for your stock?
Yes, when you hold stock and the company has profits in a certain period, they will, depending on what the board of the company decides, but they may pay you part of their earnings, right? And that's called dividends, right? So there are two ways, we'll talk about that in the next chapter, but two ways you can make money from owning stocks. One of them, the stock price will increase, and well, you don't really make money until you sell the stock. But in the meantime, as long as you hold the stock and the stock pays dividend, you are making dividend income, right? So that's a cash outflow. That's cash that goes outside the company. Of course, taxes is a big cash outflow, right? Employees, you have to pay your employees. And building and equipment and updates and maintenance and things like that. So those are all cash outflows, right? So that's and you need to make sure you have enough cash that timing is really important with cash flow, you know, when money comes in and when money goes out. You can't, you have to balance it. Just like you have to balance your own bank account, right? Sometimes you have to wait to maybe make a large purchase until your paycheck comes in. Or you use a credit card and buy it and then pay it off when your paycheck comes in. But you have to balance it out, right? You can't buy, or you can't have cash outflow if you have no cash in the bank. You have to wait for something to come in. Companies have to do the same, right? And it's a balancing act, really, right? Short-term financing options for a company. How does a company, again, financing, this is financial management, right? How does a company finance things, growth and so forth, right? Or from a startup, how does a startup, where does a startup get money from? A lot of you in your papers wrote that one day you want to have your own business. Where are you going to get the money from? Right. Here are just some examples. That's called also the 3Fs, friends, families, and fools, right? Yeah. That's one option, right? You can do it yourself, or you can ask friends and families and fools, right? That might give you money for your business, but you can use credit cards, which is very expensive. Why are credit cards expensive to use when you finance a business or anything, really? What makes credit cards expensive? Interest, that's right. Very, very high interest rates. Most of them over 20%. It's huge, right? So trade credit, what is trade credit? Do you know what trade credit is? So that's if you can get trade credit from your suppliers, right? Where they give you credit and you don't have to pay for the supplies right away. In order to do that, of course, you have to have a good relationship with your suppliers. Let's say you're a sandwich shop and you've been buying from this bakery for a while and always paying your bills on time. They might give you and they might give you credit, but they might also give you trade credit where you trade things with them, right? You can also trade. Maybe they're buying something from you, which is probably not likely in a sandwich shop. But factoring is another one that is very, very expensive, even more expensive than credit cards. Factoring is usually what companies do when they in a kind of an emergency situation. I worked for a company long time ago, and we bought a small company in Monterey, California, a service company, right? And that service company had big cash flow problems. So they could never make, they couldn't meet payroll. So, you know, end of the month, they had to pay their employees and they never had enough cash in the bank. So what they did is they went to a factoring company. So the factoring company, and it's not because it's not because the business wasn't profitable. They were profitable, just the timing was way off, right? So they were receiving the money too late, and you know, it's a legal issue if you can't pay your employees on time. So they sold their accounts receivable, the money that was going to come in from their customers at a certain date. They sold the accounts receivable to a factoring company. And the factoring company can charge whatever they want. They can charge more than credit cards, because credit cards have to, go by usury laws. Usury means the highest interest rate anybody can charge, right? But factoring companies aren't charging interest. They're buying your accounts receivable for a much lesser amount, right? Let's say you have $100,000 coming out in. They're going to give you, let's 75,000. and you have to pay it off within, I mean, you have to pay, sorry, you use that money to pay your employees. It's not like you're using that money to invest in growth activities or anything, right? So factoring is very, very expensive, yeah. When we bought that company, you know, we were immediately got rid of their factoring practices because, you know, they could have had much higher profits if they didn't depend on factoring. Right? Short-term loans and grants. So there are commercial banks that give notes. There are also non-bank lenders that are not lenders that are not banks. Microloans are small loans anywhere from $1,000 to 10,000 or something. I guess, I don't know the exact amount. Grants, what are grants? Somebody tell me what a grant is. A grant is really almost a gift, right? And grants are, you can't just say, I want to they're given by usually government institutions or not-for-profit institutions, sometimes companies and things like that. Those are things you don't have to pay back, but you have to do certain things to qualify for the grants. And it's a huge application process, right? Peer-to-peer lending. What is peer-to-peer lending? Anybody have any idea? Similar to, these are kind of similar to crowdfunding and peer-to-peer lending.
You know?
It could be people, you know, but there's this kind of in an organized way, right? Organized way, there are companies that do manage the peer-to-peer lending, right? And then finally, crowdfunding. What's crowdfunding? Has anybody heard of a crowdfunding? You know, you may have heard that for fundraising purposes. Have you ever seen or gotten information about a very tragic event? Somebody is ill, they can't pay their bills, and somebody in their network is starting this fundraiser and asking people to donate money to help this person, right? Fundraising, and then there's usually a website where you share that link. Crowdfunding is similar, except the purpose of it is not to help somebody, but the purpose is to build a business, and they will ask for money, but they do offer something in return usually. A common website that does that is Kickstarter, right? Has anybody ever heard of Kickstarter? So you have a business idea, you put it on Kickstarter, you create a really nice video about it, and you should, we don't have time to do it in class, but you should go on Kickstarter.com and look at the cool ideas. There's some really cool things and some ridiculous things as well, right? But you know, you have a Kickstarter campaign, you say, my goal is to raise $100,000 by this time, and I'm making some really cool gadget. And if you donate, and anybody, it's open to anybody. Anybody can not donate, but can kind of, I don't want to use the word invest either because you don't own part of the company, can support that company, right? An example could be, if you support us with $50, you get our first release, you get one of the products of our first release, maybe. Or you get a thank you card from us with the signature of the CEO, something useless or something useful, depending on how much you donate, right? Not donate, but how much money you use to support that company. So that's another one is Indiegogo. I haven't looked at them for a while. Look at Kickstarter, it's really interesting. In order to be successful on Kickstarter, one of the key elements is that you really present your product in a very cool and professional way. Have a great video, right? And make it sound interesting, where people go, wow, that's a great idea. And even if they're not interested, it's more likely that somebody's going, that a lot of people are going to depart with $50 from their budget versus an angel investor who's gonna have to give $100,000. It's harder to convince that, right? Yeah. So Financing long-term business needs. So there's debt financing and equity financing. Debt financing is when you get loans from a bank or a lender, right? You borrow money and pay it back with interest. You give secured bonds, corporate bonds. We know I'm not going to go into government bonds, but there are corporate bonds where basically a company can issue a bond and say, you get this bond for $1,000 and you have to hold it for 10 years. And in 10 years, this bond is going to be worth $2,000 or whatever it might be, right? I'm just making up numbers, right? So that's one way for them to collect money and eventually they'll have to pay it back, right? So it does have a built-in interest rate as well. Equity financing is some things you can do is retained earnings. So this is only possible if you're making a profit, right? A company that makes a profit, whether public or not, doesn't matter. It can be the shareholders of a not publicly traded company, right? Or it could be even just a small company owned by one person. Basically, the money that you make, the profits that you get to keep after you pay all your bills, you can either take it out and go on an expensive vacation, or you can give it to all your shareholders and they go on an expensive vacation or whatever they want to do with it, right? Or you can retain it within the company, and that's called retained earnings. Let's say you have a sandwich shop and you want to open another sandwich shop. So because you're doing really well and now you have this other location that you have scouted out, that's perfect location for you, and all the foot traffic and all that stuff, but you need money to open the shop. So the money that the profit that you're making from that one shop, you can use that money to pay part of the startup cost of the second shop. That would be retained earnings as well, right? Officially, the term retained earnings is used in companies with multiple shareholders, right? But the concept is the same. Issuing stock, whether you're public or not, you can issue shares. I want to call it shares, right? Stocks is really more for publicly traded companies, right? But a privately held company also has multiple owners. And if it's a corporation, it's the owners own shares of the company, right? You can issue more shares or more stocks and say, I make more shares or more stocks available for people to buy. What do you do when you buy a stock for a company? You have to pay for it, right? So that if you buy stock from a company directly, that company gets the money. You're investing into that company, right? Venture capitalists or investors or networks of investors, right? If you want to get venture capitalists to support you with your long-term financing needs, you have to have an extensive business plan with high potential, right? You can't just go to a VC or venture capitalist called VCs also and say, hey, can you give me $500,000? I want to do this. They're going to scrutinize you. They're not just going to give you the money because they want big returns on their investment, right? Questions? Okay, next topic is accounting, right? Accounting, they call it also the language of business. Because the numbers tell the real story. How successful is this business really? You can have a great product, you can have great marketing, great employees, you can even have happy customers, but until you look at the numbers, you don't really know how this company is doing, right? Accounting comes from the term counting, I guess. You count the money, right? It tracks income and expenses and prepares financial reports, which we will cover. So the first one was the accounting equation, also called the balance sheet, right? The balance sheet is the fundamental equation for a company. So it tells, one page, it'll tell you what the company owns, what it has in assets, and how much debt it has. So let's say I have a sandwich shop. What are some of my assets, things that I own, like equipment? I could own inventory, I could have cash in the bank, I could maybe even own the shop itself, real estate. That would be huge asset, right? But let's not do that. Let's just say we have a sandwich shop and we have, how much cash do we have in the sandwich shop? How much cash do you think we have overall on average? Maybe $5,000 cash in the bank? I don't know. You know, accounts receivable, people that owe us money, probably not likely to have in a sandwich shop because people pay directly, right? Unless I do catering and I took an order in and I have accounts receivable. You know, when you do things, when you sell things before you deliver them, you put them in your books as accounts receivable because that's an asset, because that's money that's going to come in, right? Inventory, I got lots of bread and condiments and supplies and this and that, right? Equipment, investments, let's say, you know, the sandwich shop is not gonna have any investments, but what about equipment? What kind of equipment might I have in a sandwich shop? What's that?
Refrigerator.
Yes, freezers, refrigerators, right? Cutters, counters, furniture, and that kind of stuff, right? That all has value. Those are all assets, the cash register, computers, things like that, right? And then liabilities are, so let's say my sandwich shop's assets are worth, it's a small shop. What should we say? Just give me a number. What do you think a small sandwich shop's assets might be, like Chef Lee sandwiches or something like that? That's what I was thinking too, yeah. Let's say $50,000, right? Everything I have here equals $50,000. Now, that $50,000 amounts to stuff I own and stuff I owe. So maybe, you know, of course, the cash I'm gonna own, no, but, you know, but accounts receivable as well, inventory, excess and all that stuff. But let's say I needed equipment, I needed to replace my refrigerators. So I borrowed money from a bank. That means I have debt, right? So I have to pay that off. So that would be under liabilities, right? Other liabilities are accounts payable, you know, maybe I haven't paid my bakery yet, wages payable, taxes, bonds, debt, and debt is a big one, right? In this case, especially if we financed all of our equipment with debt. So liabilities and owner's equity has to equal assets. Owner's equity, now, of course, this wouldn't be the case in a sandwich shop, but in a large corporate, in an individually owned sandwich shop, but in a large corporation, you have stocks that the owners of the company own, the shares that they have, and retained earnings, money that we made and that we're keeping, right? Reinvesting in the company. This is already paid for. We don't owe the bank for retained earnings. This is money we have earned. That becomes equity. All right, so owner's equity plus liabilities has to equal the total amount of assets. If the equation doesn't add up, there's something wrong in the accounting, right? Any questions? There are some examples. I think, do I have one here? I don't, but let me just see. I just actually explained the balance sheet to you, right? These are the three statements. So balance sheet, income statement, and statement of cash flows. I'm going to go to the next slide and show you a balance sheet. So here's the equation. I mean, again, the assets are going to be listed on the left side. You have, current assets and fixed assets. The difference is current assets are those that are more liquid, like cash, like accounts receivable. Things that are cash or can be easily converted into cash. Or inventory even, because you're going to sell it. But fixed assets are those that are fixed, like your equipment, your freezers, refrigerators, your furniture and things like that. That's fixed assets, right? there are intangible assets. Intangible assets would be things such as intellectual property, brand equity and things like that with larger companies. That has your total assets, and then with liabilities, you have short-term and long-term liabilities. Short-term liabilities are those that are paid within a year. Long-term liabilities take longer than a year, like long-term loans, for example, would be long-term liabilities. Short-term liabilities would be maybe the accounts payable that you have to pay within, 30 days or whatever, right? And then owner's equity is what the company has already paid for and already owns, right? So the next one, a really important statement, is an income statement. Can somebody give me an idea or what they think what an income statement is? Without just looking at the slide. What does the income statement tell you? What's the end number that you're looking at the income statement? Erin.
It basically just looks at your money coming in, your money necessarily going out, and what you have left after that, necessarily like your profit in a sense. It gives you an idea of your profit.
Your profit, exactly. Also, it's called profit and loss statement. So it shows your revenue. How much money are you making, right? From customers, how much are customers paying you for the product or service you're selling? Let's do a monthly income statement for the sandwich shop, hypothetically, right now. So how much did we make? How much did we have in sales in 1 month in our sandwich shop? What's that?
30,000.
30,000? That's 1,000 a day? It's kind of low, huh? You have to, let's say, 50,000. $50,000, that's still kind of low, but yeah, let's say $50,000 we sold in sandwiches. Right? And from that, we subtract something called cost of goods sold. So let's say one sandwich is sold for $5. We're really an expensive sandwich shop. You can barely get that anymore, right? I think that's to say, no, let's be current, $10. Okay, one sandwich was $10, right? How much did the ingredients in the sandwich cost us? The bread, the deli meat, the pickles, the onions, the ketchup, tomatoes, mustard, lettuce. What else do you put on it? Pepperoncini peppers. Getting hungry for lunch now. It's only breakfast time. Yes.
Does your labor cost go into
No,
that as well?
it doesn't. How much do you think, and I'm buying it from wholesalers, I'm not buying it at a grocery store, right? I'd say $2. 2 slices of bread. Well, it depends on the bread actually, but let's say we have nicer bread. Is $2 reasonable? Maybe $3? Let's do $3. So to make $50,000 and one sandwich costs $10. How many sandwiches have we sold? Divide 50,000 by 10. Divide 50,000 by 10. Simple math. Yes, 5,000. We sold 5,000 sandwiches, right? For each sandwich that we sold, we spent how much on cost of goods sold? $3 times 5,000, we spent 15,000, right? To get the ingredients of the sandwich, right? So that's our cost of goods sold. So we would have, technically we would have here, I'm going to write it down here. So we have revenue. Oh, this is not a good one. Let me see. I have a better one in my bag. It's really better to do the exercise writing it down. I don't have another pen. Here. I'll use the pink one. Can you guys see that here? Is this visible? Okay. revenue is 50,000. Minus COGS equals, we said 15,000, right? So when we subtract that, how much do we have left? Come on, math. 50,000 minus 15,000. 35,000. Okay. From that, we still have to subtract our operating expenses. Operating expenses are those that are constant regardless of how many sandwiches you sell. Cost of goods sold varies. If I sell 100,000 sandwiches instead of, $100,000 in sandwiches or 10,000 sandwiches, my cost of goods goes up to double, 30,000. But my rent is still the same. I'm still paying the same rent. I'm still paying the same insurance. I'm still paying employees the same. Unless eventually you have to hire more employees, but then your operating expenses go up. That's fine, right? It's difficult to really calculate the labor that goes into it because, you know, if you're a small sandwich shop, doesn't matter how many customers come in, you have to have at least one person there, right? So that you're paying. But anyway, so operating expenses are things that are constant. Rent is the biggest one usually, especially in the Bay Area here. Your labor, your insurance, your utilities, administrative expenses, your marketing, if you do any, those are always the same, right? So let's say what are our monthly operating expenses at a sandwich shop? Maybe we're paying 10,000 in rent. Maybe 25,000 a month, 10,000 rent, maybe 10,000 in labor costs, and then some insurance, administrative, a little bit of marketing and things like that, right? Utilities, 25,000. So we're going to operating expenses is going to be, we're going to subtract that 25,000 operating expenses, right? Now how much are we left with? 10,000. Somebody wants a piece of that. The government, right? Let's say roughly 30% tax rate. How much are we paying in taxes? If the tax rate is 30%. 3,000. Now I'm getting really, I have to write smaller here now. And we are left with how much net profits? 7,000. $7,000 net profits. What was our gross? 50,000. And we ended up with 7,000 at the end. So that's your income statement, right? Simple form. Of course, you are breaking it down by a lot of different categories, right? Very important. This is really telling you if you're profitable, if you're making or losing money. Remember we had a brief thing about break-even analysis? The numbers come from here. So you have your operating expenses, which we said were $25,000. Let's do that real quick. So what was the break-even analysis? You have your operating expenses, which is 25,000. And we divide that by, so it was by the sales price, which was $10 minus, oh, I'm sorry. I thought that was on silent already. So minus $3, the cost of goods sold, right? So 25,000 divided by 7, somebody do that real quick. Use your calculator if you can. 25,000 divided by 7.
3,507.
3,507. What is this number? This is the break-even analysis. What does this number tell us? How many sandwiches we need to sell to break even? Because from each sandwich, we make $7, right? Each sandwich sales lets us keep $7. We need to sell 3,507 sandwiches to pay 25,000 in operating expenses. That was the break-even analysis. If you remember, we covered that a couple of weeks ago. Any questions? Here's just an example. I'm going to skip this. And the last one is cash flow. As I mentioned earlier, you know, you can be really highly profitable, but you can have a negative cash flow because the timing, you're not managing your cash flow timing well, right? So for that, you have to be really, really careful. So you don't get into a situation where you have to borrow money at a very expensive cost because you don't have the cash flow to pay your bills or your employees, worst case scenario, right? You have a cash flow from operations. You know, this is all cash flow from operations. We are a sandwich shop. Our operations is making and selling sandwiches. So our sales would be from that, right? You can also have cash flow from investing activities. If you invested money into something and that brings you money back, right? And then cash flow from financing shows cash exchange between a company and its owners, shareholders, creditors, so money you pay your creditors, dividends that you may pay to your shareholders and so forth. So the cash that's going out. I mean, that's going in from those activities. Here is another example of a cash flow statement. You can examine this further in the textbook. All right, that's it for financial statements. Let me just stop this recording.